Okay, so this section is an important section. It's called the benchmark. And benchmark really is like having a dashboard. The benchmark is the dashboard of your financial affairs. If you look at a dashboard on a car, it tells you the speed you're doing, how your motor's performing, tells you what oil pressure you have, whether the battery's being charged. It's got a very important thing in there called how much petrol you've got. If you put a piece of cardboard over the top of the dashboard and you didn't get to see that, you'd be amazed how often you look at that and how difficult it is to run your car without having that information. Just even thinking about filling up the car, when did you fill it up last? How long have you driven for? All of those things. And if there was a flashing blue light in the background of the rear vision mirror, you'd be wondering, you're looking down, wondering what speed you are trying to guesstimate. It's very hard to guesstimate speed, particularly if you've driven very fast through on a 110 kilometre zone and you're coming into town. When you go down to 60, it looks like you're stopped. You have a lot of trouble judging things. And I learned to fly my helicopter. They teach you how to fly into cloud. And one of the things they do is they block your instruments, and it basically takes about 30 seconds to about a minute before you're out of control. And without instruments, you'll really cause yourself massive, massive damage. Most pilots die in that environment because those instruments are extremely important. And these are the instruments here for you. 95% of our population don't have this dashboard. They have it blank. And they're driving at night with no lights, off the road with a bank manager in the back seat saying, drive faster, drive faster. Very dangerous for them, very dangerous for you. This benchmark, all it is basically a look at where are you, and it's a quick 6-point overview. And it is in this overview that tells us what's happening. This is the outcome of your blue form. This is the outcome of your assessment where you are. I suggest people do these every 6 months. I have this benchmark done every week. And certainly you wouldn't want to go more than monthly. So let's have a look at this. If you're watching this, you may want to put your name on this and date it. I think it's a good idea because without dates, you never know what the benchmark is up to. And the whole purpose of this is turning $1 into $1 million in 7 years or less. And the quick look says, first thing, your annual income. If we have a look at that on the screen, your annual net income less your annual expenses equals your net annual savings. Now, this little section here in itself can cause some little dramas. If you're just a single person, you're working and you work in a PAYG environment, you know what your annual net income is, what your group certificate probably says, and it's after tax. So net income means when tax has been taken out, and gross means before tax. Some people do this, not annual, but they'll do it weekly or monthly and just do the multiplier and work it out. And with these forms, you can put whatever you want down. And ultimately, what we want to know is the annual position. The benchmark is usually dealt with as a up-to-date situation. So it's looking at this year, the year you just had, and kind of in the middle of that. Some of you will have increasing income, and if that was the case, I'd be writing in there, my next year I expect it to be whatever. The strategic spending will actually pick that up because that's actually dealing with it a year ahead anyway. Your expenses are the expenses that you have, which come from your strategic spending. It's very hard to do this without doing strategic spending. One of the tests that I say to people, however, is if you're not sure what you're spending and you haven't done that yet and you're unsure, just go to this one here, your annual savings. If you're not saving much, that's a hint. You're spending what you're earning. And the annual savings may be nil. If you've got an intention to increase your income and then and keep your expenses roughly the same, then obviously that will be your savings. If you have done your strategic spending, you could do the benchmark based on this is your income that you expect, this is the expenses you expect, and this is the savings. But what it is a check to see what's happening. When people normally start this off, they can 95% of the population spend all they earn or more than they earn. So when you see a minus in this savings, what it's saying is obviously you're spending more than you're earning. Anyone can do that for a period, not long. And in our abundance program, I'm going to show you how you can actually live without any income at all in the traditional sense and have your investments created for you, both in trading, buy and hold, and also with dividends and yields. So that's what that means anyway, so that's what we're really looking at. If you are in partnership, then you can draw a line down the middle and have two incomes, a husband and wife, for instance. Or if it's a business that's happening and you're in partnership with your husband or wife, then that annual net income is after the expenses of the business. In other words, the cost of goods and the cost that you have to run that business, so it becomes your net income. Okay, the next one is total assets. Now, total assets are the assets that you have, and we've put a little note here, not including home contents. And not that they're not an asset, it's just that they're not liquid. And it is important to know in your blue form what that is, only that we can see that you're not going to go and spend an extra $20,000 on furniture because you've just bought a house and you're a new married couple. A lot of people already have their contents. We're mainly looking for your assets that will be things like your house, even including your cars, mostly the assets of your assets that you have, such as shares, anything that really is of value, then in actual fact can be liquidated, some more quickly than others. And then less your total debts. Now, your debts would include your mortgage on your house, if you have a redraw facility, if you have a loan on a share portfolio, then that would be included. If you own a car and it's got a mortgage, a lease on the car, that would be included. And the cars are not such a big deal, but some people have a lot of cars, some people have a lot of money in this. If it's just a minor issue in the cars, then leave the cars out. Mainly looking for the real estate and probably the shares. Some of you have businesses, and then that has a value as well, so a note could be put on there that you've included your businesses. The trouble with the businesses is a little bit of blue sky in that, what you think it's worth to what really the asset's worth. So we probably, in looking at this, not take a big number in consideration of the blue sky of what you think the goodwill of the business is against what you could sell that business for in terms of its assets. So obviously, assets total less your debt gives you your net assets. These 2 points give us an overview of 2 important ingredients: the income that you've got, the assets you've got. Next one is cash available. What that means, it just means how much, if tomorrow you went, I need some cash, within 24 hours, where is it? This will be your bank account, and some people have it under the bed, some have it in the cookie jar. Normally it's in the various accounts you have. How much cash can you put your hands on? That shouldn't be a big number, by the way, in the sense of your money should be working for you, and having a lot of cash lying around is not a very smart thing. However, you could be in the position where you've just sold the property or you've just done something, had an inheritance, whatever. So that number could be temporarily a large number. The next one is your super fund assets, and this is, you have also space for yourself and partner there. And if you're a single person, it'll only be you. And we'd love you to put a note in that too, to know if it's a self-managed fund, if you're running that yourself, because later in this program, we're going to look at how do we invest in the abundance one. How do we invest that money? And right now you have, with very strict guidelines, the ability to borrow on your super fund and to get your super fund actively being managed. Some of you will have your funds with regular super fund managers, such as AMP and First State and others. And again, just not knowing that figure would also be a hint to me to say that you're not sure what's going on. And I believe you should know what's going on, like the dashboard. You should know what's going on, how your car is performing, how are you performing financially. Next one is, this is a very, very important, credit availability. I count this even more important really than what cash you have. Credit cards, redraw facilities, any other money. A redraw facility is the amount of money that you haven't drawn already. In other words, if you have a 300,000 mortgage availability but have drawn 200, you have 100,000 redraw available, and that would go in this section. And it wouldn't show up as a debt because you haven't drawn it. What would show up is the 200,000 that you have drawn. So we're not double counting. This is a credit, an availability of money. And your credit card credit would be the amount you have over after you've had whatever is the balance. In other words, if you have a $10,000 credit card and you have 5,000 drawn on it, you have credit available of 5,000. If you have two credit cards which have a total of 20,000 and you've drawn 7,000, then you have 13,000 available. Some of you may have other credit facilities of other drawings. The company may advance money to you. You might have bonuses that you haven't drawn for the company. There might be even money owed to you in your businesses. So that's what credit availability is. Tax position. And we just put very simple thing here. It's more of a reminder. Have you got a refund coming? Have you done your tax return? Do you owe taxes? And this can be quite critical for small businesses where they've got substantial taxes. When we do a transaction like I just showed you today, over 300,000 profit, if I don't make some provisions for this or a plan to minimise that tax legally, then I'm going to be surprised. And I don't like surprises. I like to be proactive in my planning. When we do our tax returns for our clients, we actually do the tax returns from March, April, the latest May. We do pro forma returns. We're actually checking out what would be the case if it was 30th of June, and you can roughly guess how much you're going to earn between now and then, and what would be the position if you didn't do anything. Do you owe tax? You're going to get a tax refund, and then what actions can you take to minimise that? So these are the 6 major things: your income, your assets, your cash, your super fund, your credit availability, and your tax position. They're the big indicators. Does it all make sense to everyone? Now, to have this knowledge, it gives you a feeling of certainty. And if you know the 6 human needs of certainty, variety, significance, love and connection, growth, contribution, you can actually get into action. A lot of people's fears are around that they don't know this. They don't know what's happening. I'm not an accountant. I produce this, what I call for non-accountants. All this information is readily available, and it's not to be written as to the penny. It's just to give us a guide. And what we're really wanting to do is use this benchmark to benchmark our life. Every 6 months, every 12 months, we want to see that our assets are growing, our income's growing, our cash, our ability to invest, our super fund is growing, and we can check. 95% of the population dies bankrupts at the end of the day. And what we want to be is a success story. We want to be a profitable enterprise. That's what we really want. Okay. In this form, we go on with the plan. Now, a plan is very important. And once we have a plan, we can put some strategies in place. A plan is an intention. The first one I really want you to look at is the top 3 goals. The top 3 goals that you want to really gain here. And I recommend that you consider, when you look at this benchmark, the goals for your life. They should include your health, your well-being, your family, relationships, and your money. You're not limited to 3 goals, but they should be up there as whatever you feel in the order. It doesn't have to be specifically in order, but it'd be good to cover those and be as clear as you can. Now, we're going to do a section later in Abundance on our goal setting program and our 7-year plan. And in this series, we'll be doing the 7-year plan as well. So they'll be much deeper than these top 3. However, they're important to look at. So as you're sitting watching this, maybe the mind would even start to think about that and feel what would be appropriate. And those watching or here today, if you wish to fill those in, you can. On the left-hand side here is our target dates for our $1 to $1 million. Now, traditionally, we would do this as a 1 year, 2 year, 3 year, 4 year, like that to 7 years. However, I'm going to introduce you to an idea of a 5-year plan and a 3-year plan, all starting with $1. And some of you can take longer as well. What I would just mention to you, however, is some people in the room or watching this may not even have the $1. that they have more debt than they have assets, and they're actually in minus at this point. So if you're in that situation, be mindful of that, because we need to deal with that first. And we have a section called How to Be Debt-Free in 7 years or in 5 years, and how to be also financially independent in 7 years. So if you put both of those together, it's a 12-year cycle. And that particular exercise is designed to, in the example we use anyway, pay back a complete housing loan, your car, and in this case it was a Myers account, a personal loan and a credit card. Over $127,000 was paid back under 5 years using 10% of your income and taking no risks whatsoever. So we're doing that in the Abundance Program. Right now we'll just talk about this target date, and you're the best person to judge what you want to do with this. And I would stretch you to do this. Obviously I wouldn't be trying to do it in a year. I don't think that's a very smart thing. And you can put down some dates as to what's appropriate for you. If you've got a 7-year plan, then it'll be 7 years from here, and you can work backwards for each year and put a date in. And I love to put in even the month and the day, and you'll learn in our goals program, I actually put the time in as well. I think when you put a date in, it gets very important, and when you put the time in, it gets serious, because that means the whole of the universe is working towards you to deliver this outcome. And the good news is that you're going to put it out there. It may be before that or maybe a little after that. And I can tell you, if you have an intention, at least you know what you're up to. And the universe does as well. Now, the processes that we use for this is we're using two major strategies. One is a trading strategy and one is a buy and hold strategy, or we often refer to as passive income. My truth is there's no such thing as passive income. The indication of passive income, or the intention of that, says you don't have to do anything. I believe you have to manage lots of things. Even if you bought a whole block of home units and you didn't have any mortgage on it, there's some management involved in this. You have to watch, even if you gave it to a real estate agent to manage, you have to even watch that the real estate agent's doing something. If you gave your money to the bank and had it in a term deposit, which I wouldn't recommend, but if you did, then there's even management on that in terms of, is it the right bank, is it the right interest rate, etc., etc. So the word passive means you don't do anything, and I'm going along with the statement, but basically what it is that you're not working for it, it's working for you, and I accept that as a reasonable statement. But that's what passive, or that in general intention means, passive income. Another form of passive income in shares is the yield that comes from those shares, being the dividend, which is the money that they pay on a share. A share might pay you 5% dividend, or it might pay you 10% or 7% or 3%. And the directors of the company, the equity, will determine that. So the bank, if it's a bank share, the directors of the bank will say, well, this year we're going to have a dividend of 5%. There's another little term just to confuse you. It's called franking, or these dividend imputation. Don't be confused or intimidated by these words. All it's saying is that share, the tax has been paid on it by the bank. In this case, if it was a bank share, and if it's 100% franked, that means it's 100% tax paid. In other words, at corporate tax, which is 30%, you have a 30% credit on the receipt of that money. If you're on a 30% tax rate, that means you receive that dividend in your pocket, tax paid, tax free. And people live on that, which is interesting. And of course they've got the other aspect, possible growth with the shares going up, and of course the possible decline of that as well, which some people have experienced. Okay, so that's what that word passive income. So we could get it in real estate, we can get it in shares, we can get it in businesses through equities, we can get it in fixed term securities. In the Abundance Program, we spend quite a bit of time explaining and getting you used to the idea of trading income, a much more what we call active way of making money, active management. An active management of trading, all that says is buying low, selling high, or selling high and buying low. The traditional way is buy low, sell high. In real estate, you'd buy a property for $400,000 and sell it for $500,000. And you do that within a year or two, depending on what you added value. And sometimes we can do it even in months. And it's all to do with how we buy it. We're buying at a discount before we start, we're adding some value, we're leveraging that, and we're controlling the process. We've already seen some examples in the Abundance Program how we do that. I'm going to show you some more. So what we're now putting down here is really what I call an intention for your trading income and your passive income. And we've got year 1, year 2 and year 3. And as you can see, there's real estate, there's businesses, and there's stocks and shares. And in our passive income, we've got real estate, stocks and shares, and we've also got the internet here, which is a little different from our passive situation. Now, you might say, well, I'm not sure how to fill this in, Roy. Yeah, I can understand that. And so all it is we're going to fantasize a little bit. We're going to have a little of a dream and say, well, let's give it a shot. And so we put down what would we like it to be, and then we're going to work with how we can make it that way. So, for instance, I actually think it's a very good, and depending on which way you want to go, if real estate is your number one thing, and in the Abundance Program, that's what you want to focus on, and 60% of the people who do our program, that's what it is. 20% focus on share trading as their number one thing, 20% focus on their business as their number one thing. But let's just say, for the sake of this, that real estate was your number one thing. Well, I'm going to suggest to you that you're going to be looking for $25,000, $50,000 a year for that on one transaction a year. Some of you may do 2 and some will do 3, but if you said conservatively, then I'd be putting here 25, 50 and pick the number you think's appropriate. On the second year, we often get people doing 2 transactions in a year. On the third year, we're doing 3. So if you took the lower level, even 25,000 here, this year would be 50, this year would be 75. Does that make sense? For you, you might say, no, I'm going to go 50,000, 100, 150. These are all your calls. No one can make you do anything, and no one can make your mind up for you. Only you can. Well, what I'll say to you, if you have a stand for something, and you have an intention and attention, then you'll be amazed how this starts to come together. What I want you to do is to have the goal that's applicable to you, and we do it under a SMARTY system, a specific, measurable, attainable, realistic, tangible, inspirational, emotional, leading to success. You'll see our goals program later in this series. So whatever you feel's appropriate. In business, you might have no business, or you might say, yes, I'm going to have a small business. I'm going to start that in my second year. Can you see how this is your story? And it's not for anyone else, it's just for you. And others will say, yes, I'm going to start with my stocks and shares. My first year, my first 4 months, I'll be paper trading. I'm going to have a 10,000 portfolio. I'm going to look at doubling this in my second year. So I want to increase this in my second year to, say, $20,000. And here I want it to be 50,000 on my third year. So all of these are your intention. And the good news is you can change them. You're not locked in. You can look at this every 6 months and make the adjustment. And you can set your goals. God's delays aren't God's denials. Delays are just delays. They're not denials. What's very important is that you have an intention to set what you think you would like to have happen. And similar with the passive income, you might say, well, I'm not going to be looking for that yet. I want to be more active in my management. Or some of you already have passive income streams now. Some of you already have property. Some of you already have shares. Some of you are already getting this, and some have an intention to increase that. This is going to be part of your plan. This particular video, this session, is really just about an explanation for you and to get you into action here. Okay, so this is the dashboard. This one piece of paper will be in your office, in your home office. And this is an important piece of paper. It's a document to say your financial health, where you are. Just like when you go to a doctor, takes your temperature, takes your blood pressure, takes your weight, takes your height, takes this. This is similar. These are important key elements to your life. And you want to look at this and see that it's increasing and improving. Okay, so that's that story. I wish you well with it. I would recommend that you get into this straight away as soon as you've turned this off and take the time to put it in. If you need to do this in pencil just to have a play, do that. If you wish to download this into a computer and then have it, I strongly recommend that if you're computer literate. And if you're having trouble with that, find a 14-year-old boy or girl and they'll show you how to do that. So good luck with your benchmark. Keep it up. This is your life you're holding on to.